Deferred taxes. This is a topic I hear most often from students telling me that they understand the concept and they still miss the question. So I'm going to do a video, 10 multiple choice questions on deferred taxes. The easiest shortcut to remember is, do you have a future taxable amount? Then it's a liability. You owe the IRS later. Does the IRS owe you later? Then you have a deferred tax asset. And then in the case of no future impact, it's a permanent difference. It's neither an asset or a liability. It is permanent. So let's start the first question now and watch how that shortcut works. So at December 31, read the stem for which of the following correctly classifies the items below at December 31, 20 X5. So this is going to be give you four scenarios. You got to determine if it's a DTA, a DTL, or a permanent difference. And then select the option that matches that. So the four are: gross profit from an installment sale was recognized for financial reporting in 20X5, but for the tax gain, it will be reported as cash is collected years later. So that means that it's an installment sale. You have book profit now, you have tax later. Tax later means that you owe the IRS later. That's a deferred tax liability. So the first one is a DTL, which is A, B, not C or D. So we can cross off C. That's not a deferred tax asset, at least number one. Number two, rent received in advance was included in taxable income in 20X5, but for financial reporting, it remains unearned and will be recognized as revenue in 20X6. So you have rent collected in advance. That means you're taxed now, and then it'll be booked later. That's an asset. The IRS will give you that deduction later in next year. So the second one is DTA, deferred tax asset, which means A is still good, B is crossed off, so we're crossed off B and C, and then D, deferred tax liability and deferred tax asset. So we're down to A and D. And the difference is number 3 says deferred tax asset, number 3 says no deferred tax until claims are paid. And then the fourth one, they both have permanent difference. So we don't even have to read the fourth one. We'll cross that off. It comes down to number 3, whether this is a DTA or not. So number 3, estimated warranty expense was accrued for this year, but the related costs will be deductible for tax when the claims are paid in 20X6 and later. That means it's a warranty accrued now, deducted when paid. It's a future deductible. That's a deferred tax asset because the IRS is going to owe you later. They're going to allow you that deduction later. So the third one is DTA. The only one that fits that pattern is A. Let's see. Yes, correct. And the key here is don't try to memorize this list. Just think or ask yourself what this scenario does to future taxable income. Do you owe something later, or does the IRS owe you something later? And then you can categorize them a lot easier that way. Next question. Read the stem. What deferred income tax amount should Orion report on its December 31, 20X5 balance sheet? All right, let's read the rest of the question. Make it a little bigger here. On December 31, 20X5, Orion reported equipment with a carrying amount of $540 and a tax basis of $420 because tax depreciation exceeded the book depreciation. Okay, so we've got $540 book, $420 tax. That's $120,000 future taxable amount. That's a deferred tax liability. So let's write that down. We've got $120. That's a DTL. Orion also reported $100,000 accrued warranty liability that was expensed for financial reporting in 20X5, but will not be deductible for tax until next year. So we can use that deduction on the next year tax basis. That means you've got the 100,000 difference as a deferred tax asset. Both temporary differences relate to the same tax jurisdiction and are expected to reverse in 20x6. That's important. The enacted income tax rate is 21% for this year and 25% for 20x6 and later. Assume no valuation or allowance is needed. Okay, so you want to use next year's income tax rate, not this year's, because both are expected to reverse in 20x6. You use 20x6 tax rate when they give you that 25%. Don't use 21. So 120 times 0.25 and then 100 times 0.25. That is a liability of 30, an asset of 25. Your net is 5,000 on the liability side. There's your answer. Yes. The key here is figure out what each item is, DTA, DTL, permanent, and then use the rates, the deferred rates on the future year that they give you. Don't use today's current rate. I know you're booking it for 20x5, but if they give you next year's rate, use next year's rate, the 25, not the 21. Next question. Read the stem. All temporary differences from year one are expected to reverse in year two. What amount should Pine report as total income tax expense for year one? Okay, so we've got a bunch of numbers here. So read the question. We're looking for total income tax expense. So take your pre-tax financial income, $500K. Included in that were a warranty expense of $40K, which will be deductible for tax purposes when paid in year two. Okay, so add those back to the 500. So now we're at 540. And number two, book depreciation expense of $90K. For tax purposes, Pine deducted $150K of depreciation in year one. So we've got a 60,000 difference. Need to take that out. So we're at 540 minus the 60,000 of excess depreciation. That is 540 minus 480. And which, let's see, no permanent differences. Okay. It's more likely than not that any deferred tax asset will be realized. Good. The enacted rate for year one is 25%, and then year two and later is 30%. So remember the last question. For the deferred taxes, you use the future rate, the deferred rate, which in this case will be 30, but we're doing the current total income tax expense. So we need today's rate, or this year's rate, the 25%. So 480 times 25 is going to be 120,000. There's your answer. If we were to stop there, but we need to include the deferred tax stuff. So the 40,000, not at the 25%, but at the 30%. So we've got 40 times 0.3. That's a DTA. And then what was it? The 60,000 at 0.3 for the depreciation, which is a deferred tax liability. We're going to get charged that. We're going to be disallowed that deduction in future years. So the net is a 6K expense. 18 minus 12, 6K. So add that 6 to the 120. You get your real answer of 126. Yes. The key to remember here is the current tax, use the current rate. Deferred tax, use the future rate. Next question. So read what the question's asking. Which of the following combinations best states Red's year one current income tax payable and deferred income tax expense? then the answer options give you what the current income tax payable is or could be, and the combined with the deferred income tax expense. So the first one is 115, 115, 120, 115. So three of them are 115. Deferred income tax expense of 5,000, 6,000, 0, or 24,000. So it sounds like to me, if we just figure out what the deferred income tax expense is, we'll know what the other answer is. We don't have to calculate anything else. So let's try and figure that out. Year one reported reported pre-tax financial income of 500K. Included in that was 20,000 of interest from a municipal bond. That's a permanent difference. No calculation there for your deferred income tax. It's muni, always permanent. Year one recognized 60,000 of warranty expense for financial reporting. The related cash payments will be deductible in year two. That's a deferred tax asset of 60K. At the rate of, it's deferred, so it's next year's rate. So year one is 25, year two is 30%. So 60 times 30% is 18,000. Yeah, that's right. So we have an 18,000 deferred tax asset. What was the next one? For tax purposes, depreciation exceeded book by 80K in year one, and that difference will reverse in year two. So 80,000 of not deductible future tax liability times the 30% is 24,000. So we've got a 18,000 deferred tax asset, 24,000 deferred tax liability, a net of 6,000. And there's nothing else. So we look for the one that's a deferred income tax expense of 6,000. There's one right there. I'm guessing that's the answer. We don't even need to calculate income tax payable. Yes. And the key to this question is that municipal interest is a permanent difference. So that means it affects your book income once, your taxable income once, and then you never hear from it again. It's a permanent difference that there's no future carrying deferred amount for it. Next question. Read what it's asking. What net deferred tax amount should LARC report on its December 20X5 balance sheet? Okay, so read the question. At December 20X5, LARC had no beginning deferred tax balances, no valuation allowances needed. Enacted tax rates are 30% for temporary differences reversing in 20X6 and 25% for differences in 20X7 and later. LARC expects the following temporary differences existing at the end of 20X5 to reverse as indicated. 1, taxable temporary differences from depreciation of 240,000 with 140 reversing in 20X6 and 100 in 20X7. Okay, so we're going to need to schedule this out. Let's get rid of all this. So in 20X6 and 20X7, we've got depreciation of 240 total at the end of this year, reversing 140 in 20X6, 100 in 20X7. So we need to use the rates for each of those. We were given that 30% for X6, 25% for X7. So for this one, which is depreciation or deferred tax liability, we take the 140 times the year, or times the percent that we expect that year is 42. You get your deferred tax liability of 42. And in 27, it's the 100 times 0.25. And do we have other stuff? Number 2, yes, deductible temporary differences of accrued warranty costs. So we're going to be allowed to use that deduction in future years as a deferred tax asset. 100 for 20X6. No. 170 in 20X6 and 50 in 20X7. So 70 times the 30 and the 150 times the 0.25 for 2027. So for each of those years, we've got, for 20x6, we've got the liability of 42 and an asset of 21. So a net deferred tax liability of 21. And similarly, for 20x7, it's 12 and a half of deferred tax liability. So what we're booking this year is just the sum of those two, 33,500 deferred tax liability. Not the asset, 33.5. There it is. There's your answer. Yes. And the thing to remember for a question like this is if you have different reversal years and they give you the reversing percentages or unique percentages for those years, then use that to calculate your deferred tax carrying amounts. Next question. Oh, this is a big one. Read what it's asking. What amount and classification should Micah report at the end of 20x5 under ASC 740? Okay, so let's read what the question's saying, the stem. At the end of 20x5, Micah files in one tax jurisdiction and is preparing annual financial statements. On December 20, a tax law change was enacted, reducing the corporate tax rate from 28 to 24. Okay, so because that was before the balance sheet date, you used the new enacted tax rate of 24%. Even though it's for the actual year 20x6, to book your deferreds, the next year's stuff, you would use that tax rate, that known tax rate, because it's enacted prior to the end of the year. Expected to use a temporary, because the law was enacted before December 31, use the enacted rate expected on, so it tells you, use that rate, okay? All temporary differences below are expected to reverse in 20x6 or later. Ignore uncertain tax positions, okay. US GAAP, ASC 740. Okay, so we've got some items here. We need to figure out what their deferred tax amount is, their classification and their amount, and use the 24%, not the 28%. So we're going to want to bring up our calculator again. Okay. Accrued warranty liability. Okay, so there's your deferred tax asset of 150 deductible when paid next year. So 150 times 0.24, 36. Allowance for credit losses, 80K deductible when a specific accounts are written off. So we are going to be allowed to deduct them in future years when they're written off. 80K deferred tax asset. 80 times the 0.24. Based on available evidence, it's more likely than not that 25% of this temporary difference will not be realized. Okay, it's more likely than not. We got to account for that. So draw down that 19.2 by 25% of it. So this times 0.25, but we're drawing it down. It's 4.8. So our net deferred tax asset so far is 50,400. Unrealized gain included in pre-tax book income on equity security measured at fair value through net income, 90,000 taxable when the security is sold in 20x6. So they're going to sell the security and they're going to be owing taxes on it. That's a deferred tax liability of 90K times the rate. This is a DTL. Plus 90 times 0.24, so 21 DTL. This is your DTA so far. So our net, we'll figure out the net once we have this last one. Tax depreciation exceeds book depreciation by 210. All right, so there's 210,000 that we've deducted for tax purposes above book. So this is a deferred tax liability. We're going to owe more in the future of 210. That's a big one. Times 0.24, 50,400. So our net DTL is 72. Our net DTA was 50.4. The net of the two of them is 21.6, deferred tax liability. Let's see if that's an option. 21.6. So I see it here twice. So non-current deferred tax liability, 21.6, or net current deferred tax liability of 21.6. Okay, so for ASC 740, it requires you to present deferred tax assets and liabilities as non-current items. That's why they bring up the ASC 740 here. So that's your answer? Yes. And the difference between C and D was the current versus non-current. Although numeric amount is the same, classifying the balance sheet as current is incorrect per US GAAP, ASC 740. Yes, we got it right for the right reasons. Next question. What is the action Null should take? Okay, so what is it asking? Let's get rid of this. At year end, Null, a calendar year corp, had the following temporary differences: 800,000 taxable temporary difference from depreciation, expected to reverse in 300,000 and 300,000 in 20x6, 500,000 in 20x7. 300K deductible temporary difference from accrued warranty costs expected to reverse entirely in 20x7. Okay, at 12/31, the enacted corporate tax rate was 25%. Null measured all deferred tax balances using that rate. Null expects sufficient future taxable income. Okay. On February 15, 20x6, before they issued their financial statements, a new tax law was enacted, reducing the corporate rate to 21. So it was at 25. It is now 21, enacted February after the balance sheet date. So you still use the old rate because it's after balance sheet date, even though you haven't issued your financial statements yet. That doesn't matter. You would only use the new rate if it was enacted prior to the balance sheet date. So actually, we're not going to calculate anything here. It looks like, what is the best action Null should take? Okay. So we'll look for the one that says don't use the new rate, use the old rate. So do not adjust the deferred tax balances. Keep amounts reversing measured at 25%. I like the sound of A. B, remeasure all of it at the new 21%. Nope. In 20x6, remeasure all deferred tax balances at 21%. Nope. Cross off B and C. D, keep all deferred tax balances at 25% through 20x6 and defer any measurements or recognition until 2027. No, you wouldn't defer the remeasurement until 20x7. You would just remeasure in 20x6 or next year. So I don't like D, even though it's using the current 25%, which I like. So the only one left that I like is A. That's a mouthful. I'm not going to read it. I've successfully, I think, eliminated the other three options. Yes. And let's see why D wasn't right. So appealing to those focused on tax return timing, but ASC 740 requires remeasurement in the period of enactment. Yes. So it was the law, the new tax rate was enacted in 20x6. That's when you would remeasure. So you wouldn't postpone it until 20x7. That's where that one was. That's where that gets eliminated. Next question. Okay, read what it's asking. What valuation allowance should Alder record against its deferred tax asset? December 20x5. This looks calculation heavy. I'm going to skip it. I'm just going to ask the tutor bot to explain simply how to get the answer. Let's see what it says. Calculate deferred tax assets. So it gives you a bunch of calculations to do. Determine the supported deferred tax asset. Realize this. More calculations here. Calculate the valuation allowances. Finally, the valuation allowance is the difference between the gross deferred tax asset and the supported deferred tax asset. So 215 minus the 140 equals 75. That means your answer is 75,000 D. Let's check that's right. It is. Great. use the tutor. If you don't know how to solve a question, it can give you the answer, or you can just click the button first steps and it'll give you what the first step to solving it would be without giving you the answers. Yeah, so it gives you what path to take. Good. Next question. Okay. Alder claimed $120,000 tax benefit on its year 2 income tax statement from position subject to ASC 740. As of December year 2, management concludes based solely on the technical merits that the position meets the more likely than not recognition threshold. That means you look for the outcome that is more likely than not to occur, so the one that is above 50%. Looking at this table, you've got 40% chance of the 120 outcome. That's the full tax benefit that they've allotted. Then a 20% chance of the 90. So actually, it's 60% chance that it's 90 or greater. Now that's the line where we cross the 50%, the more likely than not. That's what you end up. That's what you end up recognizing as the tax benefit, the 90K, because that's the step in the ladder where you hit above 50. Looking at the answer options, it looks like B is the one where you would recognize the 90 tax benefit, and then the 30,000 liability for the unrecognized amount, the remaining amount of the 120. That's the 30. Let's check to see if that's right. It is, and that's what it's gonna explain here. The ASC 740 uses a 2-step model. So you recognize, or more likely than not, and the measurement. So having met recognition, measurement is the largest amount of tax benefit that is greater than the 50%. So that's what we did. We found the 40 plus the 20. So you got 60% chance of the 90,000 or above. Recognize the 90, and then the remaining 30. The largest amount with the cumulative probability of above 50%. So you cumulate the odds. Just looking at them individually, you don't see anything above 50%, but you have to use the ladder. You keep adding it. So it's actually 75% chance of 60,000 or more, 90% chance of 30,000 or more, and then the 100% chance of 0 or more, of course. So that's it. That's all I wanted to show you. I know there's one more question here, but we're out of time. So I got 9 out of 10. I didn't do the last one. The key to deferred taxes is not to try and memorize each thing and what it does. There's 5 crucial rules, and they were all outlined in the multiple choice questions we just did. The first one, the direction by future effect. So if you are going to owe the IRS, that's a deferred tax liability. If the IRS is going to owe you in the future, that's a deferred tax asset. Rule number 2, the enacted rate of the reversal year. So if you're expected to reverse it next year, and you already know next year's tax rate, you use that rate to calculate. Rule number 3, the enactment date is the one that controls. So if the tax law was implemented before the balance sheet date, you use that new tax rate, even though it's for the 2026. You can book now using that rate. If the enacted law took place after the balance sheet date, January, February of the next year, then you still use the current rate, not the new enacted rate. Rule number 4, match realizability year by year. So do each year individually. You probably will get a different rate and a different direction for different items. And then the last one, which was the last multiple choice question we did, you cumulate up to 50%, right? So 40% chance of 120, you're not more likely than not yet. 20% chance of 90, then you're at 60%. So you're more likely than not at the 90. That's where you end the ladder. So Friday, I'm going to take these same rules into a task-based simulation. And I'm going to solve live a sim on deferred taxes. But if you don't want to wait for that, drill now. You get a free 20-question sample over at chatcpa.io. Start drilling today.